Now that your money is invested in the stock market, you need to be informed. In part 3 of this investing series, my grandpa and I are sharing the rules of the road. Avoid making the mistakes my grandpa made early on as he shares his best wisdom for accumulating wealth over the 55 years that he's been in the market. I'm Leah Leverich, a class of 2022 high school graduate, exploring every path to success after senior year. A big part of that success is money. Not everyone has open conversations about finances with their friends or family, and most schools don't spend a lot of time preparing us. These bonus episodes will provide you with basic financial knowledge and terminology. As you know, I have a very close relationship with my grandpa. He wasn't thrilled that I was working instead of going to college because he thought it would be harder for me to make a living. So now every time I see him, we end up talking about money. I value these conversations so much that I want you to hear them too. If you're feeling the pressure of entering the real world and need to know how to manage your finances in the simplest terms, let's explore our options together. It's our first day of class. This is Finance 101 on the Decision Day podcast. Grandpa, we want to be the smartest investor at such a young age. What do we need to know? Tell us all of your advice that you have for a first-time investor.
Keep it basic.
Okay.
Everybody will tell you diversify. But diversifying doesn't mean you got to have 100 different investments. We talked about the S&P 500. That's well diversified across a number of industries across the market. So even one investment like that with 500 companies gives you diversification without the complication part
And the
of it.
risk, right?
Yeah. Well, the risk is always even diversified. You know, let's put it this way. If you're in the S&P 500, I'd say 80%. I mean, you can also be in triple Q. It's a symbol. That's the high-tech part of, the stock market, where you have all the high-tech companies coming up with all the innovations, things like Tesla, NVIDIA, and AI, all that stuff. You can diversify by having two holdings, two exchange-traded funds, one representing the S&P, one representing the high-tech segment, or you could just stick with the S&P, and maybe 20% of your total portfolio can be in a fixed income, like a certificate of deposit, similar to what a bank would offer. Brokerage firms offer that as well. And that's it. You're diversified, but yet, you're diversified in terms of having companies that have a global reach. And yet, you don't have like 100 different stocks in your portfolio that you're trying to keep track of.
Too chaotic.
So, yeah, and you've well diversified, and you have an investment portfolio that beats most of the money managers that charge you a lot of money to manage your money. And the best kept secret is, if you walk into a money manager and you want to invest $1 million, he's going to get 1% of that.
Yeah.
Right? Which is $10,000.
Whew.
Now, somebody goes in and he has $10,000 to invest, and he's going to get 1% of that. But guess what? In order to manage $1 million or 10,000, he has to do the same thing. He's not going to take any more time to put that $1 million to work than he is that 10,000. That's the best kept secret, one of the best kept secrets in the market. So be aware of that. So why not just avoid that 1%? And sometimes it's even more. Invest it yourself. As I just mentioned, 80% S&P 500. You might want to do 70 and 10% the high tech, like triple Q symbol, and the other 20%, it can be in a fixed income, such as a CD. The younger you are, you want to be the more aggressive.
Okay, now there's this common phrase that I know a lot of people listening are probably familiar with, especially if you watch Modern Family. Phil Dunphy has said before, buy low, sell high. And that's just a comment. We hear that when we think of the stock market. What are your thoughts on that? What does it mean?
My opinion is, given that the stock market is one of the biggest wealth building strategies available, if you're well diversified, you don't sell until you need the money. You keep making those gains, keep making those compounded 10% gains until you retire. And even then, you're still going to be invested because you're still going to need income. So we're not talking, you're not a day trader, so you don't worry about buy low, sell high. Most day traders lose money in this country. I think it's like over 90% of day traders lose money. So don't even attempt that part, because there's a lot of professionals that can't do it. A lot of professionals that can't beat the S&P 500. So And here you could just buy it and pay 0.04% management fee, which is virtually nothing compared to what a money manager would charge you.
Like when we were looking in the previous episode, the tab that says realized gain and loss, mine is all zero because I've never
Right.
sold anything.
Never
So I
sold
feel like
anything.
if you want to keep your money in there for the long run, you don't have to worry about that then.
What would you sell unless you have a better investment opportunity and you already have the best? Now, there are exceptions. If you want to venture into individual stocks and you want to use maybe 1%, 1 or 2% of your portfolio to give yourself a chance to see if you can be a good stock picker after doing an analysis, and you think there's a certain company has growth potential that's going to beat the S&P 500, then, but very small amounts.
Yeah.
Those you could play with. You might say to yourself, well, 1% of my portfolio, if my portfolio is 10,000, I'm going to take 9,000 and do what we just talked about. So I have a long-term strategy. I'm never going to sell because, as the saying goes, it's not timing the market that gets you the money. It's time in the market. The longer you're in there, the more you make. So don't try to time the market. Nobody's been consistently successful in doing that. Nobody on Wall Street's going to recommend, oh yeah, you should get into a strategy that times the market. You know, you can get out before the crash, you get back in, so on. You got to be right twice. You got to be right just before the crash, and then you got to be right so that you can get in before it starts going up again. And if you miss 2 or 3 of the best trading days sometimes in a month, you can't catch up anymore. Wow. It's gone up so much. So time in the market.
Got it. Can you explain, you always remind myself, our family members, to remove emotion when you're talking about money? Like when you look at your numbers and the totals in your account, how do you not get emotional when you're looking at money?
There's going to be times in the market where you're going to look at your portfolio and you say, I'm down 50%. There's been a market crash. Now what do I do?
So you're saying the market will crash, or the market will go down?
It has done. I mean, we have, as recent as 2022, the market went down 30%. So if you had 10,000 in the beginning of the year, you might have gone down to 7,000. Then what do? You do nothing. You don't worry about it.
Okay.
Because if you're going to take any action at all, look around, see if there's money that you have available in fixed income or anywhere else, and deploy that money. Because if history repeats itself, which it has consistently over the past 120 years, it will have been an opportunity missed if you don't invest after the crash.
Because
that's
it will
where
go
the big money, that's where they say that's where the smart money goes in and buys. The average person on the street panics. And they said, well, I lost 30%, I lost 40%, now what am I going to do? I could have bought a new car, I could have done this. Well, I better sell what's left before it goes to zero.
Yeah.
They sell, and now they're out.
Now you lost.
Yes, you just locked in your loss. Now you're going around saying, okay, I lost that. I'm never going to be in the stock market again, blah, blah, blah. Until the stock market starts going up again, right? And then you hear your friends say, oh, I'm making this much. I made 20% this year. I made this. You're going to see all your buddies making all this money. And then you're going to get in again, and you're going to be lambs to the slaughter again because you're going to get in at the top. Mm-hmm. And then you're going to get crushed again. And then the smart money is going to go in again and scoop up all that you sold, all those shares you sold. They're going to buy them up because they know they've studied the market for the past 120 years.
So that's you've always told us when it
Don't
drops,
panic.
That's the best part because you know it'll only go up from there. It's not going to drop again.
It could continue to go down because you never know where the top is. You never know when the bottom.
Yeah.
If the market is down 50%, well, it could go down another 10, another 15%. What you do is you start buying, let's say it's down 10%, you buy a little bit more. It's down 20, buy more, buy more. That's why you always want to have some cash. That's that fixed income that I told you about. Oh. You want to have that cash available on that CD. That CD buffered your account while it was going down because that CD did not go down. But now that the market's crashing, my strategy has always been, okay, start deploying that cash now from the CD into the market.
And in the same realm of that, what is the difference between a bear market and a bull market?
It's a market cycle. The market goes through those bear bull market cycles. If you go into a bear market, usually it's defined as once the market drops 10%, you're essentially considered in a bear market. It could continue to go down, or it could reverse and then start going up again. And when it's going up, if it's up 10%, it's kind of considered a bull market. But
So we want a bull market.
Yeah, there's no clear definitions. Well, technically, if you're just starting out now and you're accumulating money in the market, you don't want a bull market because you want to be able to deploy and put money in when the stocks are down.
Because you want it to be at a
Yeah.
bull market when you take out the money, right? You want it to be
when you need
high.
it, when you need the money, because you never take it all out, because it keeps compounding at that 10% rate. So you never, even in retirement, you don't want to take it out because you need that money to produce income for you.
We want to buy shares of the S&P 500 IVV
Yeah.
when the market is down a little
Yes.
bit. Like
Yeah,
when
you-
you look at it on a week, you're not going to see major dips and all of that, but you want to put your money, you want to buy a share when it's down, right?
Well, yeah, even on a regular basis, yeah, if the market's down 1%, oh, we had a bad day today. Well, that's not a bad. If you had that enough money to buy one or two shares of the S&P 500, yeah, you tweak it like that. You kind of try to time it in terms of if you have a big down day, which there are a lot of big up and down days, so you take advantage of the big down days to buy those couple shares.
Okay.
But consistently, it'll go up and down, but it goes up 70% of the time. Okay? So 30% of the time it goes down, 70% of the time it goes up. So overall, I'll take 70 versus 30 any day.
That's the sales
Yeah.
pitch right there
Yeah.
of why you should be in
Yeah.
the stock market.
Yeah.
So when it is time for us to take out the money, or if we do have something that we do want to
If you're
sell or
buying a
remove,
house, you take out.
so how do you do it? How do you take it out?
Yeah, well then you go in and sell. Let's say you're buying a house and you need money for the down payment. Let's say you need $50,000, and if you're holding $100,000 worth of the S&P 500, you sell half of your position.
Okay.
Of course, you're going to have to pay capital gains tax.
How does that work?
Depending on how much you make, you pay capital gains tax at about a 15% rate, which is less than income tax.
Oh,
That's
so
right.
you have to pay the government money for what you made in the stock market
Yes, for your
because
gains.
you didn't work
Yeah.
for that, you just
But it's-
made it.
Yeah, but it's less. A lot of people complain about that. They say, well, if I earn $100, I have to pay a tax rate of 22%. My tax rate is, but if I earn $100 in the stock market, those people only have to pay 15% tax rate. But it's structured like that to encourage people to invest and grow the economy. Without investors in the stock market, you wouldn't have companies like Microsoft and Google and all that, because they started from nothing. They started with people investing in an idea. If you don't have those investors, how's the company going to grow?
That's a great
Yeah.
way to describe
Yeah.
it and simplify it. There you go. With all of that information, I mean, that's pretty impressive. If somebody's listening and now with this knowledge, they're able to freely talk with somebody about the stock market. Like imagine going up to an adult and being like, yeah, I've got a few shares of the S&P 500, IVV. I think this was super valuable. This is the final episode of the 3-part series of investing in the stock market. If you have any other topics or specific questions about your finances as we enter the adult world after graduating high school, feel free to message us at Decision Day Podcast on social media or decisiondaypodcast@gmail.com. You can leave a review, leave 5 stars if you want. There's also the frequently asked questions link in every description of every episode. We are here to help you and to make you feel confident as you enter the working world with your finances and with the money that you're making. So thank you, Grandpa, for another amazing few episodes. We look forward to sharing more with you in the next one.
Thank you, Leah.